Let's start by understanding what is your view on the broader market in terms of valuations, in terms of ownership, the way retail and HNI has got active. What are your thoughts on ownership? This was an area which was completely shunned for almost 2.5 years. You look at valuations and other parameters of mid-caps very closely. What are your broad thoughts there before we get into the kind of approach you're taking to your fund?
Thank you, Ajay. Thank you for having us over at your on the channel. I think the broader markets have rallied. I think valuations definitely seems to be on the higher side. It is getting stretched given the kind of earnings one will see in FY21. But if I think what is also happening is people are already started building in how FY22 will pan out. And that FY22, if the COVID issues gets more or less resolved or is not, it doesn't get accentuated, FY22 earnings will definitely look better than FY21, given the fact that FY21, the base will be very low. In the mid cap and small cap space, there are pockets which are a little on the expensive side, but there are a lot of spaces where a fund manager can still find a lot of value. And if someone builds in a portfolio with a 3 to 5 year view, I think there is a lot of money to be made in the mid and small cap space. We remain constructive on it. We are cognizant that some of the spaces are expensive. We have tried to avoid them. Financials is the one sector where we are cautious. We've been cautious for the last 15 to 18 months, primarily because of stretched valuations, over ownership, and the high leverage that this sector has. Besides that, I think there are a lot of stocks across sectors where we see decent upside over the medium to long term.
Aniruddha, let's build on that particular point. Let's talk about the PGIM India Mid-Cap Opportunities Fund in terms of forward earnings. If one were to take a block of 2 years far ahead, not one, what kind of forward earnings growth are you estimating of your Mid-Cap Opportunities Fund 2 year far out?
Sure. Ajay, I think you'll have to give me the leeway of building it over 3 years, because this year will definitely be a beaten down year. And it will be very difficult to predict how earnings will play out. But over the next couple of years beyond, I think so, earnings of about 16 to 18% earnings growth over the next 2 years. And why 2 years? Even over the next 3 years should be possible. There is enough cushion in the stocks that we've built in, where earnings visibility is definitely coming through, but the PE re-rating still needs to happen.
Sure, fair point. What I meant was 2 year plus. So because the kind of environment we are going through, 1.5 up to 2 years is not the right thing. Perhaps we'll have to see in a block of 3 years. I was looking at the construction of your portfolio. It was very interesting to see financials barely 4-5% of your portfolio. Whereas if I take into account pesticides or Rasayan kind of stocks, even pharma, they make almost 25% of your portfolio. You've got a good blend of agrochemicals, specialty chemicals, crop science stocks, as well as even on the pharma side, you have biologics, CROs, domestic pharma, as well as export opportunities. Talk to us about this end of your portfolio, the kind of earning profile to watch out for.
Sure. So to give you a sense on our financials, this financial stance, I think somewhere around the IL&FS issue was when we turned cautious on the financials, because it has a cascading effect. It is one of the most levered sectors. Generally, financials leverage starts at about 4 times, and we've been very risk averse in terms of building into too much of levered businesses. It was overowned. Most portfolios had a decent amount of exposure to financials. So it had all the 3 things going against it: leverage, over ownership, and stretched valuations. That was one of the reasons why we went really underweight financials, and that call played out well for us. We always try to look at businesses, and this is to address the second part of your question. We always try to look at businesses in the history rather than try to predict what earnings look like. The history of a company over business cycles, it gives you a sense of how strong the business is, especially at the bottom of a cycle. What is the kind of cash flows they are generating? The pharma, agrochemical, chemical basket fit that basket, that thesis very well. They were strong cash flow generators. And this is talking from a bottom-up side. They had strong cash flows, very clean balance sheets, and they had growth enablers because they were well capitalized, and they had the pharma had some kind of a molecule or some kind of technology which has helped them. We also, the fact this was, other than the bottom up, I think generally top down, on the agrochemical and chemical side, last kharif season monsoons were pretty good, and and similar was the case with the rabi crop. And the farmer doesn't compromise on quality because he wants to save his crop. So that was one reason why we built into strongly into rural India. And Pharma space, the call was that it was a beaten down sector. It had, but very clean balance sheets and cash flows. So we took a 3-year view and built the portfolio around good businesses with strong cash flows and low amount of debt. And we were probably lucky that a decent part of that has already played out in the next 6 months since we built it.
What are your thoughts on auto ancillary space and how they can become, very kind of global standards? And how are you looking at the valuations of auto ancillary companies here in India? You have a reasonable exposure there.
Sure, Ajay. I think if you take the auto and auto ancillary together, this has been an industry which has been underappreciated, but it has actually successfully turned into an exporter for the country. If you look at the two-wheelers, four-wheelers, etc., it is pretty much a hub globally for a lot of low-cost cars and two-wheelers getting exported to that extent. On the auto ancillary side, I think if you take a 3-year view from here, our belief is these are companies which are going through they've gone through a lot of correction to that extent. But again, it fits into our philosophy of clean balance sheets, very low debt, most of them, manageable debt, and they are probably at the bottom of the cycle. What we are trying to see, which are the companies which are generating operating cash flows here, positive operating cash flows. If they survive this cycle, it is most likely they'll come out stronger. We believe the next 3 to 5 years, given where India is as a per capita GDP, there will be enough and more of demand for cars and two-wheelers. The next 6 months might be uncertain, but over the next 3 years to 5 years, the demand for two-wheelers, four-wheelers, and even trucks will definitely come back. And if the fortunes of the OEMs change for the positive, auto ancillaries will give you a bigger leverage to that extent, because these are smaller companies, and hence there can be a lot of returns which can be made from this segment.
Fair point. Right. Let's talk about the construction and cement space, because high frequency data seem to be indicating that in the tier 2, tier 3 towns, the demand for construction quality steel and cement continues to be pretty healthy and steady. And many of our managements we speak to also are concurring with this view and give us similar kind of views. So what are your thoughts on cement? You have a small exposure there. Construction, again, small exposure. But if you take overall cement, construction, home improvement, what are your thoughts there? Because very good clutch of mid caps are available there.
Sure. You've pointed it absolutely right, Ajay. What we do is we remain positive on cement. This being the monsoon season, this is going to be a weak quarter. And if this is a weak quarter, probably you might just get it at a reasonable price. But over the kind of demand scenario that is there and the pricing holding on, we think if rural India does well and individual housing does well, cement as a sector should do well. Our philosophy, again, to give you a sense, cement companies, if you look at them, most of them have never diluted equity. And that is something that we like. Clean balance sheets, great cash flows, operating cash flows, and dilution hasn't happened in most of them. Vis-a-vis construction companies, where you see a lot of dilution in equity happening for them to grow. So our preference will always be towards cement companies to participate in the growth of or to participate in the construction segment or the overall growth in infrastructure. So cement would be the proxy that we will definitely latch on
to. Consumer durables, Dixon Tech, Whirlpool, Voltas, Relaxo. Relaxo, I recently came to know, has become one of the largest players of organized manufacturers of footwear globally. Of course, Whirlpool, Dixon are also talking of improved demand from the smaller towns and getting contracts for manufacturing. Well, what are your thoughts on the valuation of this entire pocket consumer durables, and is there any risk also to their business models, given that discretionary income of people is getting affected because of the slowdown, and hence the need for that incremental air conditioner in the house, the room which doesn't have an AC, or maybe upgrading the television set may be put in abeyance for some time?
Sure, Ajay. I think your point is valid. It's just that we've been holding on these companies for the last couple of years. We see them as very structural growth stories, which will play out over the next 5-10 years. As we speak, even now, the penetration level of white goods is very low in the country. And as India graduates into probably a higher per capita GDP, the consumption will definitely come back. There are names there probably which will participate in the government's push towards manufacturing in the country. But generally, consumption and discretionary consumption will no doubt see a slowdown over the next 3 to 6 months. But we are hopeful that things will come back. And if someone takes a 3-year view, we always like to build into positions in their weakness, because you get them probably at a reasonable valuation. Having said that, some of the names are stretched. What we are trying to just focus on is the fact that the quality of these businesses should be good, and the ticket sizes for these discretionary items should be on the lower side, so that if at all there is a cut in the discretionary item, you wouldn't see too much of a cut probably happening on footwear or any of the garments, etc. And that is something that we have kept at the back of our mind.
Aniruddha, you will be quite pleased to know that a lot of people are listening to our conversations here live and asking me questions to ask you, even on Twitter. So I am just putting a viewer question to you. One of the viewers is highlighting that Bharat Rasayan is actually your biggest individual holding in your fund, almost 5%. So he is asking what makes you so bullish, not on this company, but on the space, and how many other companies are also now being recognized, or anything incremental you may share on the space and just your the earnings potential, etc. Not a reaction on that particular stock.
Sure. What we usually do, Ajay, is we go down into the history of these companies, and we've done that with every company that is literally there in the portfolio. We look at the last 5 years, 10 years history, if available. Now, some of these companies have, through the cycles, generated positive operating cash flows, which is a very strong statement. Again, the bottom-up segment doing well. And this is in a segment, agrochemical and pesticides, fertilizers, chemicals are a segment where you've got a lot of government intervention. And in spite of them, and stretched working cycles, these companies have been able to generate positive operating cash flows. That shows the strength of these companies, frankly speaking, that in spite of government intervention, pricing being set by the government, working capitals being stretched, they have been able to generate positive operating cash flows. Now, over the last couple of years, the government has focused on, enriching the rural side of the country, because they were going through a lot of pain. So there was a systemic wealth transfer in a managed way, which was happening to uplift rural India, where clearly if money is flowing there, our idea was to follow the money and look at companies who would benefit from this transition that was happening of money flowing into rural India. And some of the players out there happen to be the value chains of pesticides, chemicals, agrochemicals, tractors, tillers, and that was one of the reasons why we went ahead and built this. Today, the farmer is at a far better position than probably what he was 2 years back, thanks to the government's policies and a good monsoon that is playing out both last year and this year. So we think this will be something which will sustain. Also, the pricing policies, etc., have helped in terms of crop pricing. So we remain positive on them, but we are cognizant that some of them have become expensive. So at a right moment, probably we will take some money out of it, where valuations are not justified by future earnings growth.
The reason I'm asking you the question is that when you interact with these mid-capish companies across the country, these guys are the worst affected or have been the direct affected. What kind of commentary are you gathering from the basket of mid-cap company managements you are in touch with on some early signs, or what are the difficulties they're facing if one were to take a call on how things would be in next 6 to 12 months far out?
Sure, Jay. So our interactions clearly indicate that they have gone through pain. Working capitals have got stretched. Funding has been an issue, and there are a set of companies which will probably not see the light of the day beyond this tunnel. But to that extent, as we mentioned, our focus has clearly been on companies with excess of capital. And to that extent, our portfolios have very little of debt companies on our portfolio. Uh, and the likelihood of these companies where we've gone ahead and invested, they will definitely survive the down cycle just because of the clean balance sheets that they have. And at the bottom of the cycle, again, cash flows are strong. So we aren't too concerned about the companies that are there in the portfolio. But yes, what could at most happen is things are getting stretched. Working capital could get stretched. Some amount of debt might get built into these clean balance sheets. But they will, over a time, if one believes that over the next 1 year or so, things will get sorted out and India starts, clearly on the recovery path. These will be intermittent problems, and our belief is in the next couple of quarters, things should start looking far better than where we are.
Aniruddha, you have 7% of your weight in software, but these are largest mid-cap companies. What do you make of this issue?
I think you are absolutely right. I don't see the federal government is a very small client for most of the IT companies. Uh, they didn't have access to the federal government accounts, and to that extent, they have been left out of that big market. So, if there is a curb on that side of it, it will not affect the Indian IT companies in a large way. The reason why we continue to remain positive on the Indian IT companies, especially in a scenario like this, is the fact that in spite of there has been an earnings degrowth in many of them for whatever they have reported, but the earnings degrowth compared to other sectors have been they have come out far stronger than most of the other companies on the other sectors who have reported. So they lend stability again to that extent, and the visibility of earnings as things come back over the next 2 to 4 quarters, or probably over the next couple of years, will remain strong. Uh, with the US elections coming, I think there is going to be a lot of noise with regards to IT and pharma, where Trump needs to win his election, so he will accordingly make announcements. But structurally, over the next 2 3 years, I don't see anything really hampering the future growth or prospects of both these sectors.